Okay, let's unpack this. Welcome to the deep dive. Today, we are strapping in for a really comprehensive look at the architecture of the financial world. Specifically, we're talking about the core instruments and, the investment channels that really direct global capital flow.
It's the plumbing of the system, really.
It is. And our mission over the next 30 minutes or so isn't just to, list a bunch of definitions.
Right.
It's to give you a fast, thorough understanding of where money goes, how risk is defined and quantified, and how all these complex mechanisms actually work together.
We want to cut through that information overload that makes this all feel so inaccessible.
Exactly. We're building a kind of conceptual map of the financial universe.
So when we first look at this vast landscape of investment, the sources show us we can start by segmenting it into two really broad buckets. It's based on what you actually get.
Yeah, what you're buying.
On one side, we have financial investments. These are essentially paper claims on future cash flows.
It's a contract. Right. It's a contract. In exchange of cash for a promise of cash later.
Yeah.
You're buying a promise.
And then on the other side, completely different, you have non-financial investments.
The physical stuff.
The physical stuff, exactly. Tangible assets, things you can actually see and touch. So this would be real estate, gold, commodities. The value is tied to the physical good itself, not a legal contract.
Okay, so that's the what. But then beyond the asset type, there are these key structural classifications that define where and how the money gets traded.
Right. And first up is the classic distinction between public versus private markets.
So stock exchanges versus, say, venture capital.
Exactly. Public markets offer high liquidity, lots of transparency. Private markets are, well, they're less regulated, much less liquid, and they're really catering to a different kind of investor.
And then crucially, opportunities are classified by the maturity profile. The timeline. This is the difference between the capital market and the money market. The money market is all about immediate short-term needs. Liquidity. We're talking instruments that mature in less than a year.
Like treasury bills or commercial paper.
Yeah, that sort of thing. But the capital market, that deals in the long-term instruments. Stocks, bonds, things that finance long-term growth and can stretch out for decades.
But if we zoom past all these classifications, and look at the absolute core building blocks of any financial instrument, everything, it basically boils down to two generic types.
Just two.
Just two. And it's based entirely on the type of claim they give you on those future cash flows. And this distinction, this is the very backbone of the whole investment universe. It determines everything. Risk, return, all of it.
So what are they?
Debt and equity.
All right, let's start at the top of that risk-return spectrum with ownership. We are talking about equity shares. When you buy an equity share, you're not just placing a bet. You are buying an actual fraction of a company.
A piece of the business.
A piece of the business.
Okay.
And that gives you two primary, very concrete rights. First, the right to future profit sharing. And second, generally, voting rights in key corporate decisions.
And this brings us to one of the most fundamental concepts in finance. I mean, if you want to understand equity risk, you have to understand this. Equity holders are legally defined as residual claimants.
Residual claimants. Okay, break that down.
It means that if the company generates a profit, or on the flip side, if it goes bankrupt and its assets are liquidated, the equity holders are the absolute last people in line to get paid.
The absolute last.
The last. They only receive profits or assets after every single other obligation, interest to debt holders, payments to suppliers, employee wages, taxes, has been fully paid.
So they're claiming the residue, the leftovers.
They're claiming the leftovers.
Here's where it gets really interesting, though. That status, being the residual claimant, that's precisely why equity is the riskiest asset class. But also, it's the one with the highest potential return.
Exactly.
If the company fails, you could be wiped out. You get nothing. But if it thrives, that residual pool of profit can grow exponentially.
And your returns, as you said, come through two main avenues. First, dividends, which are basically distributions of profit that the board decides to pay out.
And they don't have to?
They don't have to, no. And second, and this is often much more significant, especially in growth companies, through capital appreciation, that's just the increase in the share price itself.
Which reflects the market's belief in the company's future value.
Precisely. And for investors who are looking beyond just the next quarter, we have to talk about the long-term advantage here, a concept known as time diversification.
Okay, time diversification.
What this means in practice is that while equities can be incredibly volatile day to day.
Wildly volatile.
And they're constantly getting battered by market sentiment, holding them over a long enough time horizon, think 10, 20, or 30 years. It historically allows you to smooth out those sharp market dips.
So you're riding out the storms.
You're riding out the storms. The long-term trajectory of economic growth and compounding returns, it tends to dominate the short-term noise. It effectively reduces risk fluctuations and significantly improves your risk-adjusted returns over that period. You're betting on the resilience of the market itself.
Okay, so that's pure ownership with common equity. But what if an investor wants, I don't know, a slice of that ownership pie, but with a bit more stability, a kind of safety rail?
That's where preference shares come in.
And these aren't just one simple category, right? They're often called hybrid or blended securities.
Yeah, because they artfully combine two separate worlds. They have elements of equity-like ownership and often perpetuity, meaning they don't have a fixed maturity date. But they also have key characteristics you'd normally associate with debt.
Like fixed payments.
Exactly, the expectation of fixed or predetermined payments.
And what's so fascinating here is how they slot into the company's capital structure. Where do they sit in that line for payment?
They're designed to act as a crucial seniority buffer. They sit right between pure debt and common equity. So they rank above common equity shares when it comes to receiving dividend payments.
So the company has to pay them before the common shareholders get anything.
That's right. And critically, if the company is liquidated, preference shareholders also have priority in getting paid from the company's net assets over the common equity holders.
That's a valuable feature. It's called liquidation preference.
It is. This priority makes them structurally safer than common equity. It reduces the risk of a total loss. And that debt characteristic is that they often feature those fixed dividend payments, much like the interest you'd get from a corporate bond.
So, okay, if they offer greater payment certainty and this liquidation preference, what's the massive downside? Why would anyone choose common equity instead?
The trade-off is control. Preference shares generally do not come with voting rights like common equity shares do.
So you don't get a say in how the company is run.
You don't. If you want to influence management, vote on a merger, or elect the board, preference shares strip you of that influence. You're trading your political power for payment priority.
And I guess you're also trading away the huge upside, right?
Absolutely. While the dividend is fixed and safer, you generally don't get to participate in that massive upside if the company's profits just explode. That exponential growth is reserved for the residual claimant, the common equity holder.
And the world of preference shares isn't just one thing. It splits into 4 distinct, kind of nuanced categories that dictate exactly how you get paid.
Right, and you need to know these when you're looking at a balance sheet.
First up, you have accumulation rights. So cumulative preference shares are designed to protect you during the company's lean years. If the company struggles and skips a dividend payment, those unpaid dividends, they accumulate. They become an arrear.
And they have to be paid in full before any common equity holder sees a penny of profit down the line. It makes them significantly safer.
The opposite of that is non-cumulative. If a dividend is omitted in a tough year, well, it's just lost. It's gone forever.
Then you analyze the participation rights. Non-participating preference shares have their dividend paid at a strictly fixed rate. It's static. It is not tied to the company's annual earnings at all. It's really just a fixed income substitute.
But a participating preference share. Now that sounds more interesting.
It's more complex, yeah, and more exciting. The holder gets their specified fixed dividend, plus they receive an additional, usually variable dividend based on some pre-specified conditions.
For example?
Well, for example, they might get an extra payout if the company's net profit goes over a certain threshold. It lets them capture some of the firm's runaway success without having to bear that full residual risk.
We should probably also give a quick mention to convertible preference shares.
Oh, absolutely. They add another layer of strategic flexibility.
How so?
They give the shareholder the right, but not the obligation, to convert their preference shares into a specified number of common equity shares, usually at a set ratio.
So you can start with the safety of fixed payments, but then pivot to capture that high capital appreciation if the company really takes off.
Exactly. It's the best of both worlds, potentially.
Okay, so moving from preferential payouts to differential control, we get to something called differential voting rights, or DVRs.
Right. And in most modern corporate governance, the ideal is that democratic one share, one vote principle for common equity. Everyone gets an equal say per share.
But DVRs are designed specifically to break that ideal.
They are. They're shares that offer either superior or, more commonly, inferior voting rights, or sometimes different dividends compared to ordinary shares.
And why do they exist? What's the point?
Typically, it's to allow founders or promoters to raise a lot of equity capital without diluting their effective control over the business. They can sell shares, but keep the voting power.
What's interesting is the regulatory context. They've been permitted in India since 2000, but they've seen pretty limited adoption. Seems like most investors really prefer that standard voting structure.
They do.
But there is a famous example, one that perfectly illustrates the trade-off here. Tata Motors. They were among the first big companies to issue DVRs way back in 2008.
And the structure was very explicit. The holders of these DVRs were given a drastically reduced level of control.
How much?
Specifically, 1/10 the standard voting rights of a common equity share.
1/10. Wow.
But to compensate them for that massive reduction in influence, those investors were given a financial incentive, a 5% higher dividend than the common equity holders.
So it's a classic trade. You consciously trade your political influence for better current income.
Precisely. It often appeals to investors who trust the current management and just want a predictable cash flow stream. They're not activists.
We have seen other issuers, though they're less prominent. Pantaloons Retail, Gujarat NRE Coke, Jain Irrigation Systems.
Yeah. The existence of DVRs just reinforces the point that ownership isn't always equal. It's a negotiated financial contract with different terms for different investors.
Okay, let's shift gears entirely. We're moving from ownership, which is fundamentally based on hope for a residual profit, to lending, which is based on a promise. We are entering the world of debt, also known as fixed income.
A different universe.
Completely.
Yeah.
The fundamental definition of a debt instrument is simple, but it's ironclad. It is a legally binding promise by the issuer, the borrower, to pay a specified stream of cash flows to the investor, the creditor.
And that's all happening during the term of the contract. And it culminates in the return of the principal amount at the end, at maturity.
The contract itself, often called the indenture, is vital here.
It's everything. It doesn't just establish the borrowing requirements, it critically spells out the rights of the holder if the borrower defaults.
And that's a key distinction from equity.
A critical one. When a debt instrument defaults, the contract usually gives the holder the right to seize collateral or force a restructuring. Equity holders don't have that luxury. They just absorb the loss.
We also distinguish debt by its tradability, right?
We do. Transferable debt lets the investor sell the instrument on the open market, which provides liquidity. Non-transferable debt prohibits that sale. You have to hold it to maturity, which
significantly reduces your liquidity. You're locked in.
You're locked in.
And debt securities are issued by a huge spectrum of entities. I mean, from multinational companies looking for expansion capital to local municipalities funding a new bridge.
To state governments, and right at the top of the pyramid, sovereign governments, which is just the term for a national government issuing debt.
And this brings us to the bedrock of the entire debt market in many economies, including India, government securities, or GSECs.
What's fascinating here is that GSECs form the largest, most crucial component of the entire Indian debt market. A GSEC is simply a tradable instrument issued by either the central or state governments acknowledging a debt to the holder.
And we classify these strictly by maturity.
Right. The short-term ones, those maturing in less than 1 year, are called treasury bills, or T-bills.
And they don't pay interest in the traditional way.
No, they don't pay a coupon. They're sold at a discount to their face value. And your return is simply the difference between what you paid and the face value you get back at maturity.
The long-term instruments are called bonds, or dated securities. These have maturities of 1 year or more, and they can stretch out for, 40 years sometimes?
Sometimes, yeah. And these typically pay periodic interest, which we call the coupon.
And specifically, bonds issued by state governments to fund their spending are known as state development loans, or SDLs.
Correct.
Now let's talk about that unique safety feature. Because GSECs are backed by the full taxing and borrowing power of the national government, they're often called risk-free, gilt-edged instruments.
That term gilt-edged implies the highest possible quality. And they carry practically no risk of default, which makes them the absolute benchmark against which all other credit risk is measured.
But wait, I have to challenge that term risk-free.
Oh, okay.
I mean, are they really free of all risk?
That's an excellent point. No, they are free of default risk. The sovereign can always, in theory, print currency or raise taxes to pay its obligations. But they are not free of interest rate risk. If prevailing rates in the economy rise, the price of your existing lower rate bond falls. And they're not free of inflation risk, where the value of your future payments gets eroded by rising prices.
So when we say risk-free in finance, we're being very specific.
Very specific. We're referring only to the absence of the chance that the borrower will fail to make the promised payment. That distinction is crucial.
That is a great refinement. Okay, moving to the corporate world. The sources note that a large chunk of corporate borrowing in India actually happens in the unlisted space.
Right, through direct loans from banks or private placements.
But for the listed corporate debt, we immediately confront the cost of risk. Corporate debt has to pay significantly higher interest rates than GSECs.
Well, they have to. They need to compensate investors for bearing default risk. You're no longer lending to the government. You're lending to a business that's subject to competition, management failure, market cycles.
And that extra payment, that risk premium, is what makes corporate debt attractive.
And this difference in yield is precisely quantified by a term you'll hear all the time: credit spread.
The credit spread.
It's the calculated difference between the yield you get on a government security and the yield on a corporate security of the exact same maturity.
So you can think of the credit spread as the company's risk premium.
Or, more colloquially, the fear tax. It's the extra charge investors demand for bearing the default risk associated with that company. If the economy is healthy, spreads might be tight, a low-risk premium. If a recession looms, the credit spread widens dramatically because the market is demanding much higher compensation for that fear of default.
So how do we translate that vague fear of default into a measurable, standardized metric?
That is the job of the credit rating system.
Using ratings from SEBI-registered agencies.
Exactly. These agencies analyze the issuer's financials, their industry position, their leverage, and they assign a letter grade.
Okay, let's run through the investment grade scale. At the very top, we have AAA. AAA.
Which signifies the highest degree of safety and the lowest possible credit risk. This is a blue-chip company in the debt world.
Just below that, AA indicates high safety, very low credit risk. We move down to A, which is adequate safety, low credit risk.
And then you hit the critical threshold, BBB, or BBB.
Why is that the critical one?
It still represents moderate safety and moderate credit risk, but it's the lowest grade still considered acceptable for most big institutional portfolios. Bonds rated BBB and above are classified as investment grade.
And these are the ones that fiduciaries like pension funds and insurance companies are often required to hold.
That's right. They have a duty to protect capital.
Below that BBB line, the risk profile changes dramatically.
And the spreads widen significantly.
Bonds rated below BBB are considered high yield or, less flatteringly, junk bonds.
They involve a high probability of default. They pay those higher yields precisely because they are inherently riskier.
And because of that elevated risk, many institutional investors are strictly prohibited from investing in them. You're chasing a massive capital gain if the company pulls through, but you risk losing your principal.
And the ultimate risk signal, the absolute bottom, is a D rating.
That's the default.
D for default. It means the instrument is either already in default on its obligations or is expected to be in default very, very soon.
Okay, we spent a lot of time on paper, claims, debt, and equity, which are all about promises of future cash. Let's switch to the tangible world. Non-financial investments, starting with commodities.
Right, the physical assets. We classify these into two distinct groups. You have soft commodities, which are grown or raised.
Like corn, wheat, livestock.
Exactly. And then you have hard commodities, which are mined or extracted. Gold, silver, crude oil, copper.
Soft commodities are fascinating because they have this unique and extreme price volatility. Why is that?
Well, for one, they're often perishable, and their supply is subject to the completely unpredictable whims of nature.
So a critical factor is the prediction of weather.
Absolutely. A drought in one key growing region can send futures prices soaring instantly. A bumper harvest can tank the market. The prices are purely determined by constantly shifting physical demand and supply.
And when you're trading these, the way you hold them really influences the return structure, right? There are costs involved.
Oh, definitely. Because they're physical, they incur storage costs. This often leads to situations like contango, where the future price of a commodity is higher than the spot price today. That difference often reflects the cost of storing it until that future date.
Historically, one of the main appeals of soft commodities, for a diversified portfolio at least, is their low correlation with stocks and bonds.
Right. They provide a genuine diversification benefit. They tend to zig when the equity market zags. When equity markets panic over geopolitics, commodities often become a safe harbor.
But we have to remember the crucial structural difference. Commodities do not generate current income.
This is key. Unlike a bond that pays interest, or a stock that might pay a dividend, there is no inherent yield. You are relying solely on capital appreciation.
The hope that you can sell it for more than you bought it for?
That's the entire game.
And your exposure to these assets is typically taken not by, arranging for a truckload of soybeans to be delivered to your house.
Yeah, thankfully.
But through financial contracts, specifically derivative contracts like forwards or futures. It's much more practical.
Much more.
For hard commodities like industrial metals and oil, the price is determined by the interaction between global industrial demand, geopolitics, and supply.
But the undisputed star of the hard asset world has to be gold.
The safe haven.
The ultimate safe haven asset. Because of its global acceptability and centuries of history as a store of value, it performs particularly well during periods of intense economic uncertainty, high inflation, or severe geopolitical crises. Investors flee from volatile paper assets and back to a physical metal.
Next up, let's talk about real estate, a huge, complicated asset class.
Massive. It's a huge driver of economic growth, and it's prized by investors because it offers excellent diversification away from financial markets.
And it also acts as a really effective inflation hedge.
It does. Property values and rents generally keep pace with rising consumer prices.
Investors typically have two main objectives when they're buying property. First, capital appreciation, hoping the value goes up.
And second, generating regular income through rents.
We subclassify real estate extensively, commercial versus residential, and across different geographic markets. I mean, in India, the difference between a Tier I city like Mumbai and a Tier 3 city is enormous.
Huge differences in liquidity, rent yield, appreciation potential. It requires very careful, localized research.
The primary barrier to direct real estate investment, though, is just the sheer size of the commitment.
Right. Direct ownership involves large capital commitments, high transaction costs, and it's very illiquid. You can't just sell a building in 5 minutes on the stock exchange.
Yeah. But to lower that barrier, investors can now get exposure with smaller amounts through pooled vehicles like real estate investment trusts or REITs.
Or specialized real estate funds, yeah. REITs in particular are required to distribute a high percentage of their rental income back to the unit holders.
So they offer an income stream that's comparable to rent, but you get the liquidity of a listed stock.
Exactly.
Finally, let's venture into the world of specialized and exotic assets. This is where the pros look for alpha outside of the traditional markets.
This includes things like structured products. These are customized, highly sophisticated investments that package multiple assets together, like bonds, options, derivatives, to provide a very specific risk-adjusted exposure.
The sources mention market-linked debentures, or MLDs, as a common example in India.
Right, where the return is tied to the performance of an underlying index or asset.
Then you have distressed securities.
This is a fascinating area. These are the bonds or stocks of companies that are in severe financial trouble, near bankruptcy, or already in default.
And because the market expects them to fail, these securities trade at huge discounts.
Cents on the dollar, often. They're sometimes poetically called fallen angels.
Fallen angels? Why?
Because they were once high-quality, investment-grade assets that have crashed to distressed levels because of some company failure or scandal. Trading them requires deep, specialized experience and valuation, often forensic accounting, to see if there's any residual value left.
And finally, we have art and collectibles.
These offer genuine portfolio diversification because they historically show extremely low correlation with both equities and bonds. They just follow their own market dynamics, taste, provenance, history.
But the risks are intense.
Oh, absolutely. They're big ticket, highly illiquid, completely unregulated, and critically, each piece is unique. They are non-standard, which makes them notoriously difficult to value.
For those interested in accessing global assets, we should probably wrap this section by mentioning the Liberalized Remittance Scheme, or LRS limit.
Yes. This is the mechanism by which an Indian individual can invest a maximum of $250,000 abroad every year. It allows for exposure to international instruments and markets, which can really enhance diversification.
Okay, we've defined what you can invest in. Now we need to discuss how you access those assets.
Yeah.
And we see a fundamental split here. Direct versus advised investing.
Right. Direct investments are pretty straightforward. The investor buys securities directly from the issuer or on an exchange.
You're doing it all yourself.
You're doing it yourself. This channel demands that you have substantial time, expertise, and a lot of confidence in your own judgment.
If you don't have that, you turn to the advised model, and specifically to a registered investment advisor, or RIA.
These are qualified professionals licensed by SEBI who provide personalized investment advice for a clear fee.
And the regulatory distinction here is crucial. It's based on a big reform in 2013. Mutual fund distributors or brokers whose pay often depends on the product they sell.
They can no longer claim the title of advisor unless they are licensed as an RIA.
So it separates the seller of financial products from the genuine fee-only advisor.
And the core ethical requirement for RIAs is that they operate under a fiduciary duty. Meaning they are legally mandated to offer advice that is always in the investor's best interest, and they must always disclose any conflicts of interest right up front. Their job isn't to sell you the product that pays them the highest commission. It's to find the best product for you.
And the RIA's value add, it goes way beyond just picking a list of stocks.
Oh, absolutely. Their primary function is helping investors develop discipline. They do this by performing thorough risk profiling, assessing your long-term needs, and developing a formal, structured financial plan. They build the sustainable structure, which is arguably more important than the individual stock picks.
Okay, that brings us to indirect investing and managed portfolios. This is the channel for those who want professional management without the high costs of a private RIA.
Right. This model works by using vehicles that pool money from hundreds or thousands of investors to buy and manage securities on their collective behalf.
The advantage is scale.
It's all about scalability. By pooling capital, retail investors get access to professional expertise, high-quality research, and diversification at much lower costs than they'd face on their own.
And examples of these managed solutions in India include the big, highly regulated mutual funds, or MFs.
The newer, less regulated alternative investment funds, or AIFs, and customized services from portfolio managers, or PMs.
Let's explore the regulation of those big three, MFs, AIFs, and PMS. They're all regulated by SEBI, but the level of oversight is explicitly tiered. It's based on the client they serve.
Right. Mutual funds are the most stringently and restrictively regulated.
Why is that?
Because they cater primarily to the mass market, the retail investor.
Yeah.
So the regulations prioritize safety, liquidity, transparency, and strict limits on what they can hold or how much leverage they can use. They are designed to protect the unsophisticated client above all.
And in sharp contrast to that, you have AIFs and PMS. They operate under what's called light touch regulation.
Yeah, because they cater exclusively to sophisticated and high net worth investors. The regulator expects them to understand and be able to bear complex, specialized risks.
This is exactly why they're often called the rich man's mutual fund.
That's the perfect term for it, and we can use an analogy to really crystallize this difference.
Okay.
If direct investing is like buying individual ingredients to cook a specific meal yourself, you need high skill and a lot of time.
The pooled vehicles are like different forms of dining out.
Exactly. Mutual funds are like a popular, highly regulated buffet.
A buffet. I like that.
It's affordable, it's open to everyone, it offers standardized dishes or portfolios, and it's strictly monitored for hygiene and safety by the regulator.
But PMS and AIFs, they're like a private chef service.
A private chef service, it's far more expensive. An AIF requires a minimum investment of 1 crore rupees. PMS requires a minimum of 50 lakhs.
And because they're customized for a sophisticated palate, the private chef has way more freedom in the kitchen.
That freedom is the key. That's the light touch regulation. PMS and AIF managers can use more aggressive tools that mutual funds just can't, like substantial leverage, short selling, investing in illiquid, unlisted assets.
Like private equity or real estate projects.
All in the pursuit of higher returns. This requires the client to sign off on a much higher risk profile, which is what justifies those elevated minimum investment requirements.
Okay, to really become fluent in finance and decode these instruments, we need to internalize some of the common vocabulary in the core analytical frameworks.
Right. When we talk about your investments as a whole, the collective noun for all your securities and holdings is your portfolio.
And when you're reviewing company data, it's important to remember the difference between paper profit and real cash. Accrual accounting allows companies to book revenues or expenses when a transaction occurs, even if the cash hasn't actually moved yet.
which is standard practice, but it can sometimes make reported profits look very different from a company's actual cash flow. That's why analysts always scrutinize the cash flow statement.
We also classify businesses by how they react to the broader economic cycle. Cyclical sectors do extremely well during economic expansions.
Think luxury goods, airlines, consumer durables. They expand faster than the economy.
Conversely, defensive businesses are counter-cyclical. They tend to hold up better during a recession.
Consumers still need basic necessities regardless of the job market. So pharmaceuticals, essential utilities, basic food providers fall into this category.
A key measure for economists is a leading economic indicator.
This is a measurable statistic or factor that shows improvement before the actual measured economy does. The stock market itself is a great example. Investors move based on expected future performance.
Let's focus deeply on risk. Risk isn't just one general term. It breaks down into specific, quantifiable types.
Right. First, there's idiosyncratic risk. This is risk that is specific to a particular company or sector.
For example, a sudden government ban on a certain type of plastic packaging. That's idiosyncratic to that industry. It won't affect a bank or an ID firm.
And the key thing is, you can diversify this risk away by holding a broad portfolio.
Then you have market risk, sometimes called systemic risk.
This is the risk from broad market dynamics, like a pandemic, a war, a sudden rise in global interest rates, that affects all listed assets. You cannot diversify away market risk.
And we measure this using beta.
Exactly. Beta tells you how volatile an asset's returns are compared to the overall market. A beta of 1.5 means the stock moves 50% more sharply than the market, up or down.
Another crucial concept related to the trading process itself is impact cost.
This is a sophisticated measure of liquidity risk. It represents the percentage price movement that's caused by a specific order size.
So if you place a big order for a highly liquid stock, the price barely moves. The impact cost is low.
But if you place that same big order for an illiquid small-cap stock, the price might jump sharply against you. That's a high-impact cost, reflecting poor market depth.
And finally, currency risk. This is vital, especially for international institutional investors, the FPIs.
It arises when exchange rates are volatile. An FPI might make a fantastic return in rupees, but if the rupee depreciates significantly against their home currency, say the US dollar,
their final dollar-denominated return is eroded,
directly impacting their profitability.
So if we connect all of this to the bigger picture, all this analysis leads to one critical goal: valuation.
The key objective for any buy-side analyst is to determine a stock's intrinsic value, its true, fair value, through research and modeling. This analytically derived value is then compared against its current market price.
If the market price is lower than your intrinsic value, the stock is undervalued and a potential buy.
And a standard approach to this process uses the EIC framework. EIC stands for economy, industry, and company.
It's a systematic filter.
It's a funnel. You start with macroeconomic factors, then you narrow down to the specific industry dynamics, and finally, you focus on the individual company's financials, management, and growth prospects, macro to micro.
And when you look at research reports, they generally come from two distinct sides of the investment world:
Sell side and buy side.
Sell-side research is produced by brokers and investment banks for their external clients. Their goal is often to facilitate trading and generate commissions.
Buy-side research, on the other hand, is generated internally, solely for the benefit of the firm's own fund managers, like at a mutual fund or an AIF. Their research is focused purely on finding alpha for their own portfolio.
When analyzing industries, they often follow a pattern: the industry life cycle. One notable phase is maturity.
This is typically the longest phase. It's characterized by stable growth that generally matches the economy's overall growth rate. Competition is extremely high, and the focus shifts from rapid expansion to just efficiency and market share defense.
To understand where a specific company sits within that mature industry, we often conduct a SWOT analysis.
A systematic evaluation of the firm's internal strengths and weaknesses, and its external opportunities and threats.
This raises what is perhaps the single most crucial philosophical distinction we have covered today.
The tension that drives all investment decisions.
The crucial distinction, the one we must always remember, is this: price is a fact. It's the market quote you see on the screen right now. It's dictated by the immediate supply and demand of the crowd. But value is an opinion.
It's an analytical estimate derived from all the research frameworks we just discussed. #tag out TRO. So, to synthesize all the ground we've covered, we've established the fundamental hierarchy of financial claims. We've seen how equity, The residual claimant contrasts with debt, which is an absolute promise.
Right.
We then saw how default risk gets precisely quantified and translated through the crucial role of ratings, which allows us to measure risk against the risk-free safety of sovereign GSECs via the credit spread.
And finally, we explored that tiered access available through managed portfolios, from the highly regulated mutual fund buffet
To the high-net-worth private chef services of AIFs and PMS. Understanding these underlying structures isn't just academic. It's the foundational first step to making any financial plan effective.
So you, the investor, are always aware of the inherent risk embedded in every asset you hold. Exactly.
So what does this all mean? We've established that price is a fact, but value is an opinion. And we noted that sovereign GSECs are the absolute default-free benchmark. Everything else in the debt world is priced relative to that benchmark, with ever higher spreads for higher default risk. So here is a final provocative thought for you to mull over. If sovereign GSECs are the foundation of the debt world and you encounter one of those highly distressed securities, a fallen angel that has been beaten down by the market priced far below any common sense level, what kind of due diligence does one owe themselves when trying to determine the value of that asset? Knowing its price has fallen dramatically because of the market's expectation of imminent default. That distance between the panicked price and your calculated opinion of its true intrinsic value is where the most asymmetrical, high-risk, high-reward investment opportunities lie. But capturing that value demands due diligence that isn't just thorough, it has to be truly forensic.
That's the real challenge.
That's the real challenge of the